We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. You want to find out more about Brian and the team, you can always go to the website, deckerretirementplanning.com, deckerretirementplanning.com. And as we say every week on the program, if you go to the heading of Safer Retirement Education on deckerretirementplanning.com, the heading of Safer Retirement Education, there are like 12 different things you can download, including Brian's book on retirement, The Decker Approach, 3 Principles of Retirement Book, Checklist, Challenge, Sample Income Plan. Those are just 4 of the things you can download. There's no cost to you. There's no obligation. There's no pressure whatsoever. Again, that's all on deckerretirementplanning.com. If you have any questions about what Brian and the team talk about today, it's 833-707-3030. No cost, no obligation, no pressure. The team is here to help if they can. They just don't know if they can until they hear from you. Again, that number is 833-707-3030. We'll give that number to you throughout the program. So, Brian, we've got another Decker Retirement Planning advisor in today out of the Salt Lake Lehi offices. That would be Arrin Wray. Welcome, Arrin.
Thank you. I'm happy to be here.
All right, Brian, give us some insight into Arrin.
Arrin came with us. He came through internally after spending a few years helping behind the scenes create these plans that are so awesome, where clients can see their different levels, different sources of income. Arrin organizes them on a spreadsheet we call a distribution plan, and he shows their Social Security, their pension, their rental income, shows their portfolio income, looks at their age, calculates how much they can draw net of taxes per year and per month with a COLA, cost of living adjustment, to their age 100. It's quite the feat. Arrin's has years of experience doing that. And he said, I want to meet with clients directly.
Brian's going to ask you a lot of questions, and they're going to be tough questions. You're going to have to handle them for all of our listeners to understand what happened in 2022. What's the outlook for 2023? Are you ready to tackle some of these questions?
I sure am.
All right, Brian, there you go. Arrin is ready to go.
All right. We had the worst year since 2008 last year, 2022. Arrin, there's 3 reasons markets go up. 1, a declining interest rate environment. Did we have that last year?
Nope.
An accommodative Fed is the second reason. Did we have that last year?
Absolutely not.
And the third is higher corporate earnings. Did we have that last year?
Nope. Third strike.
And then we have some geopolitical activity in Eastern Europe, didn't we?
Just a little bit. Yep.
So we had a war, we had rising interest rates, we had inflation, in fact. Let's talk for a second about how these individually take a toll on the market. So let's talk about the Fed, for example. Rising interest rates, if there's a lot of people who, when interest rates go down and their CDs at 8% come due and they can reinvest them at 3%, they say, geez, Exxon's paying a 4% dividend. I would just rather take my chances on that. And they're going into the markets as interest rates go down. The opposite is true when interest rates go up. When interest rates go up and they see that they can get 5% on a 2 or 3 year treasury note or CD, they're thinking, I just lost 30% last year. I'll lock in 5%. I'm happy with that. So a part of their portfolio comes out of the stock market and goes into fixed income. So rising interest rates has a declining effect on the stock market. Anything you'd add to that, Arrin?
No, I agree. It's like you said, especially where in recent hindsight, people have lost 20 to 30% in 2022. It's a little more enticing when people are like, hey, I can get 5% fixed. There's no room for loss. I know exactly what I'm going to get, and it's going to be a positive return.
And on top of that, the Fed is saying that they've got at least 2 more rate hikes coming. They're saying that publicly, and that they're not going to be lowering rates. So anyone who is pulling money out of the markets, is getting pretty good rates coming in. Now, when it comes to the expectation that people have for the markets in 2023, declining interest rates and a word called recession, the R word, is prevalent because probably the best predictor of a recession, Arrin, is where we have an inverted yield curve. Talk to our listeners about the inverted yield curve and why that's such a good indicator of recessions.
Yeah, so inverted yield curve is just where short-term T-notes, treasury notes are paying a higher yield than the long-term ones. A lot of times people will look at the 2-year versus the 10-year yield, and it's been inverted, meaning that the short-term are paying more than the long-term. It's been that way for a number of months now, and usually when the yield curve is inverted, that signals an upcoming recession. So a lot of people have been using that as one data point for pointing towards an upcoming recession, where it has been very inverted for a number of months now.
Now, interest rates have played a part in a rising interest rate environment, in the Fed and what they're doing. And now we're talking about an inverted yield curve. Interest rates are very much a key component of why stock markets go up or down. From 1940, the 10-year Treasury was at 2%. 40 years later, the 10-year Treasury in 1980 was at 15%. Rising interest rates for 40 years. Then, for 40 years, 1980 to 2020, interest rates went from 15% on the 10-year down to 0.47 in August of 2020. So now we have rising interest rate environment. That means that what worked in the last 40 years probably won't work. Let's stay on interest rates for a few more minutes here, Arrin. What happens to bond funds when interest rates go up?
They lose value.
But banks and brokers are telling their clients that bond funds are where you put your safe money.
Yeah, unfortunately, that's a pretty prevalent piece of financial information at this point in time. I feel like it's just one of those age-old things that people parrot no matter what the financial or economic circumstances are. So there are times when they can be useful. Right now is not one of those times.
Okay, and you're being more kind than I would be. I think that it's they've always done it this way. They know better. They've passed their Series 7 or Series 65. They're tested to know, and still they tell people to put their safe money in bond funds when the Fed has got 2 more rate hikes coming up. I just don't get that. I guess that's a kind way to put it, isn't it?
No, I agree with
last year in 2022, the average bond fund was down over 20%. Do you know that was the worst? Mark, you keep these statistics. That was the worst year for bond funds in over 100 years. Did you know that, Arrin?
I did. Yep. That's why those traditional 60-40, 70-30 portfolios took a beating, and people were not expecting that, especially as they're getting closer to retirement. They think that the 40 or 30% is supposed to be the safe part.
Okay, now there's something called, in mutual funds, there's something called strategy creep. Let's say that you're a growth fund and that you're low beta. And let's say that I'm a growth fund and I'm not low beta. So I have a lot of technology in my portfolio, and you get ranked among your peers according to your performance net of fees, Arrin. So you see that for the last at least 20 years, probably 30, technology stocks are tearing the cover off the ball. Yes, 2000, 01, and 02, the tech bubble burst. Technology was down 70%. But who thinks back that far? So you have these technology stocks that are coming in your portfolio more and more, even though you're just a regular growth fund. The technology part of your portfolio keeps going up. Do you know that at the very end of this bubble, before it burst, there was something called FANG. There was something called FANG, FAANGM. Facebook, Apple, Amazon, Netflix, Google, Microsoft. That worked until it didn't. That kept cranking out huge returns. And then when interest rates go up, it has its biggest effect on technology stocks. And so they tanked really hard last year. Those stocks were down over 40% collectively. S&P said that the average loss in the United States for people in the stock market was 35%. So yes, the S&P was down just shy of 20%. NASDAQ was down 33%. Bond funds down 20%. Arrin, how much did our clients lose in their emergency cash, discretionary cash, bucket 1, 2, 3, 4, 5, and 6? Those are all principal guaranteed accounts. How much did they lose?
Zero.
And how much exposure to the stock market does our risk accounts have typically?
Oh, pretty low. I mean, we have the two-sided models, and they do a fantastic job of helping to reduce any of that drawdown that the typical market would provide.
No, I mean, is it 60-40, 70-30? How much exposure do our retired clients have to the stock market?
I would say most are 20%, 20 to 25%, somewhere in that range.
I agree. So 20 to 25%. So in retirement, you have two things that are critically important. One is your new checkbook, your new checks that come in each month to pay the bills. You need income. And the second thing you want to do is have something that fills what you've drawn in the next 20 years. So if it's what you say, 80-20, 75-25, with only 20-25%, in 20 years, you spend through laddered principal guaranteed accounts, 1, 3, 5, 7, 10, taxable and tax-free income streams in the principal guaranteed accounts. Why is that important, Arrin, that you're drawing income from principal guaranteed accounts? Why not throw it all in a pie chart where things are all fluctuating? Why do you draw it from laddered principal guaranteed accounts?
Because that's the best way to do it, where you can provide the safety and the income that you're looking for. If you're going to take the gamble, just throw it all in the market and hope the market's at your back. That's a pretty big risk to take in your retirement years when you no longer have that income providing your spending money. You don't have the ability to wait another 30 years to be able to recover if you have those major losses. If you're following some percentage withdrawal rule, say the 4% rule in retirement, then obviously you need the market to increase year over year to make that feasible. If there's a couple down years like the early 2000s, you've cut half or more of your retirement assets out within just a couple years, and now you can no longer afford to stay retired. But by using those laddered principal guaranteed accounts, it doesn't really matter what the stock market has done. You still have those principal guaranteed sources. You're not going to lose any money. You have that stable income coming in, and it provides a lot of peace of mind for our clients to know that a significant portion of their money is protected from any of those stock market fluctuations.
So if you think about it, most of you listening probably are not 20% in the market, 80% safe. The team at Decker Retirement understand that the idea is that you need to make sure that your money will last as long as you need it to last. We don't know how long that is. Don't know if you're both going to hit 100. One of you hits 92, the other one 77. We don't know that. So that's how the planning all goes together to create the Decker approach, the safer retirement approach that Brian and his team use. If you would like to sit down with the team and learn more about how this approach might give you a little bit more confidence and clarity into your retirement, give the team a call. There's no cost for this. 833-707-3030. 833-707-3030. There's no judgment either. The team is here to help if they can. They just don't know if they can help until you reach out. Again, why would you not take advantage of this opportunity to chat with the team at Decker Retirement about where you are on your road to retirement? 833-707-3030. We're just getting started. We're recapping 2022. We're going to look ahead to 2023. And then we're going to talk a little bit more about what Brian and the team at Decker Retirement can do for you possibly when it comes to your retirement plan. Again, Brian J. Decker and Arrin Wray back with more right here on Safer Retirement Radio.
Just as the seasons come and go, so too do the markets ebb and flow. If market volatility is making you nervous, give Brian a call and make sure you're not taking on more risk than you're comfortable with. 833-707-3030. That's 833-707-3030. Decker Retirement Planning has a question for you. Is your retirement inflation-proofed? Here's what we mean. In retirement, chances are you're on a fixed income with variable expenses. So how do you not run out of money when the cost of just about everything continues to go up? You inflation-proof it. Brian Decker and the team at Decker Retirement Planning can show you strategies to help combat inflation so it doesn't outpace your retirement income.
Call Brian Decker today at 833-707-3030.
To learn more, inflation could take a huge chunk out of your retirement savings, but it doesn't have to. With some simple planning, inflation can go from being a major disruption to a minor annoyance. Call Brian and the team at Decker Retirement Planning now to start inflation-proofing your retirement today.
At 833-707-3030. 833-707-3030.
Investing involves risk.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. You can always go to the website to learn more, DeckerRetirementPlanning.com. Under the heading of Safer Retirement Education, there's 12 different things you can download, including Brian's book on retirement, The Decker Approach. A lot of great information for you there. Maybe you'll read some of it, you'll download some of this, and then you'll have questions. You can always call the team as well, because there's no cost, no obligation to go to that Safer Retirement Education and download Brian's book and some of the other options you have available. And there's no cost to chat with the team. They're here to help if they can. They just don't know if they can help you until you reach out. It's 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us today. Brian and Arrin were talking about 2022. And then we're going to look ahead to 2023, but you're not quite finished with 2022, are you, Brian?
No, let's talk about, so we talked about, there's three parts to a portfolio. One is cash, one is safe money, and the other is risk. I think we covered the cash and the safe money. And I think foundationally, Arrin, you mentioned that the most important thing we do for our clients is how we draw their income in retirement. And that's from a laddered principal guaranteed source. And we're a math-based firm. If factually, mathematically, if you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. That's not what you want to do in retirement. So in retirement, we're specialists. That's all we do. We manage money for clients. We provide a plan. We help them know how much money they can have after taxes to spend, and we put a COLA so that every year they get a little more money because of inflation. And we do that to age 100. The number one fear that people have in the United States of people over 65 is running out of money before they die, because they're looking at a pie chart and trying to figure out how much money they can draw from a pie chart. No wonder that's the number one fear. Let's talk about the second fear, Arrin, and that is these market hits that come through. There's a lot of smart people that say, we're not done yet with the downside that started when the markets peaked in November of 2021. And by the way, something interesting happened in November of 2021. I'll set this up. There have been 4 times that the S&P 500 is traded in valuation above 30 times trailing earnings. One was 1929. Let that sink in. It took 17 years to get your money back. The second time was 1964. It took 18 years to get your money back. The last time was November of 2021. We traded at 32 times earnings. Arrin, if history repeats, and I haven't asked you, but I personally believe it will on this, that means that we're going to look at 10, 15 years of flat, choppy markets. It's called a digestion period in the markets. When markets get so expensive and highly valued, we start an up interest rate cycle. We have world markets that go into recession, which, by the way, is the expectation for this year, 2023. And then you have markets that go up and down and don't go anywhere for 10, 15 years. In that situation, let's go back to our portfolio approach. Arrin, the fixed principal guaranteed accounts with fixed rates are going to make, they're like CDs. They're going to make their rates. That's bucket one, that's bucket two, three. Those accounts are going to produce that fixed rate, whether the markets go up or down, right?
Correct. Yep.
And then we have in buckets 4 and 5 and 6 smart beta indexes that are principal guaranteed, that are able to allocate money between stocks, bonds, and commodities on a daily basis. They can make money in a drop like 2008 or 2001 and 02. They don't need a higher market to make money on principal guaranteed basis. It's only one scenario that they really struggle, and that is 2015, 2018, and last year, 2022, when stocks, bonds, and commodities all decline at the same time. That makes it very difficult for these smart beta indexes to make money. But going forward, Arrin, if we have 15 years of, I don't know, flat, choppy markets, historically, in the last 22 years, there's only been 3 times that the stocks, bonds, and commodities have all gone down. So that means that going forward, it's highly unlikely that in 15 years that they wouldn't make money in, I don't know, 11 of those years, but something like that. We're just using history as a guide. So the expectation is that our clients, imagine that you're 65 and retired and you've got 1.2 million, Arrin, and your portfolio doesn't make anything for 15 years. A lot of those people, they have to go back to work. Would you agree?
Oh, yeah. That'd be a terrible scenario.
And yet what we're talking about is putting together a portfolio for retirees where all of their laddered principal guaranteed accounts are able to make money in most of those years, most all of those years. And so our clients are way ahead. But let's talk about the risk part of the portfolio. To catch people up, historically, they've made money in 2000, 01, 02, 08. So Arrin, talk to us about how the risk managers work. We have 5 different models. Give us some background. Did we just say, hey, here's 5 managers, let's just use these? I'm sure there's better out there. Let's just use these 5. Was that our approach? Give us some background, Arrin, on our approach to the risk side of clients' retirement plans.
Sure. So realizing that a couple of things have changed since your working years, when you're thinking about risk and risk planning, you got to realize that there's a couple differences in investing for retirement versus investing when you're 30, 40 years old. You have a while to go until you actually need those assets. The first is that the time horizon has changed, where you no longer have another 30 years, 40 years to ride out the volatility in the stock market. And the second is that you need to spend the money instead of having it just set aside, and it doesn't really matter if it goes up and down for that point in time. So in retirement, you kind of have this quandary where you don't want to just shove it all into cash where it's 100% liquid and safe, but you're not really earning anything. But you also don't want to have it stuck 100% in the market where you risk those 30, 40, 50% drops, and then you either have to make drastic financial decisions or you have to head back to a second career, back to work again. So we do a pretty in-depth research process to make sure that we are finding the best, highest producing net of fee risk managers for each of our clients. And so we go out to some of the biggest databases in the world. We use the Morningstar database, we use the Wilshire database, and we have a couple others that we aggregate data from to help us narrow down who we use as investment managers for our clients. And going through that process helps us to be able to narrow down those managers that use what are called two-sided trend following models. And those allow us to be able to take advantage of all sorts of different market cycles. So if, like you predicted, Brian, and I tend to agree, the next 10 to 15 years is going to be very flat, choppy, not this straight up market that we've had for the last 10 or 12 years. The way that people are going to be able to make money in the stock market is also going to change. I'm sure everybody listening would agree that they don't want to wait another 10 or 15 years just to break even on their stock or index investments. And so for us, we take a different approach where we have active management that allows us to be able to take advantage of those different market cycles and help people still make money, even if the S&P or the NASDAQ is flat or just has up and down chop for the next 10 or 15 years.
Okay, I love that this kind of technology strategies have been around for 25 years. These are models that are designed to make money in up or down markets. They're computer models. They're trend following. They are able to make money when markets go up. They go to cash when the markets go down. They protect you in a down market. They're able to hit our two key points for risk managers. One, to protect capital in a down market for clients in retirement. And two, they're able to make money in a down market. So last year was the first year that the 5 managers together didn't make money, but clients were still happy because S&P was down almost 20%, NASDAQ down 33%. Our clients on the risk portion, this is 25% of their money, was down about 5%. When we add up to the whole portfolio together, the 75% that made money, our clients, their total portfolio, they made money last year.
So I think if you get the idea, I mean, if you're 30 or 40 years old, you're sitting down with Brian or Arrin talking about what you should be doing with your money, it's a different scenario when you're 55, 65, you're in retirement, right? And that's the idea, Decker Retirement. That's why the company is called Decker Retirement Planning. It is about now, how do we make sure that our money lasts as long as we need it? Income, investment, taxes, healthcare, legacy planning, Social Security, it's in the income part, healthcare, it's in the healthcare part. There's a lot of moving pieces, and Brian and Arrin and the team at Decker Retirement are here to help you, and it's different than your asset, your accumulation phase, your working years. It's a distribution phase in retirement. So that means there's different strategies. And that's what Brian and Arrin are talking about today. If you'd like to learn more about how this might affect you, 833-707-3030 might ease some of the stress that you had in 2022 when you saw your accounts dropping. 833-707-3030. So we're going to start looking ahead at some point here in the very near future when we come back about 2023. What's ahead? And certainly it's not a bright and rosy picture because that's what Arrin and Brian have been talking about. But what are some of the things we should be looking at, and how can Decker Retirement help us? Well, stay with us and find out. This is Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning.
Excited for retirement? All that daydreaming can be time-consuming enough as it is. So why not get a little help with your retirement planning? Call Brian at 833-707-2020 and see where you stand in retirement.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, you can always go to the website to learn more, DeckerRetirementPlanning.com. And again, you can go to the Safer Retirement Education heading right under that on Decker Retirement Planning's website. And there's a lot of things you can download, including Brian's book on retirement, the Decker Approach book, 3 Principles of Retirement book, the Checklist Challenge, Sample Income Plan. That's just 4 of the 12 things you can download right there on the website. There's no cost, no obligation to you. It is there for your information. If you have questions, concerns, you're not really sure what you should be doing. We know the outlook is not great for the markets and the bond market. As long as the Fed keeps raising the interest rates, bonds aren't going to go in the right direction. What do we do? 833-707-3030 is the number, 833-707-3030 to chat with the team at Decker Retirement. There's no cost to do so. There's no obligation. There's no pressure. There's no judgment either. Brian is letting me stick with my blockbuster video stocks because they're going to come back at some point. He said, yeah, just keep holding on to them. They're going to come back, I'm sure. So there's a lot of bad decisions that we make. This is not really about history. This is about going forward. How can the team help you? And Brian, I know you're talking about risk, that basically while we're working, we probably have 80 to 90% of our money in the markets and at risk. We get into retirement, we got to kind of flip-flop those numbers a little bit and have a little bit more money on the safe side. So how do you look at that 25% that is in the risk category that's sitting over there growing while we're using money to live on? How does that all play out?
That's the backfill money. Arrin, talk to us about that. That Mark just set it up perfectly, that you spend through the 75, 80% of that money in the first 20 years from laddered principal guaranteed accounts. and markets can go up or down, interest rates can go up or down, the economy can go up or down. And our clients are fine because they're drawing from laddered principal guaranteed accounts. They have tremendous peace of mind. So what happens? How does that work? What's the purpose of that 20-25% risk funds as opposed to the principal guaranteed money?
I love this topic, Brian. This is one of my favorite parts of the way that we set up our income distribution plans because it helps clients to be able to have a sustainable level of income throughout their entire retirement year period. A lot of times it's just kind of a gamble. People just hope that the money's going to last, but we set it up from a math-based, principle-based approach where, like you said, at the beginning, we put into place laddered principal guaranteed accounts that'll last for about 20 years. And during the course of the time that those principal guaranteed accounts are supplying income, we have that smaller portion, that usually 20-25% of their total assets in that risk section that is growing, compounding, and that by the end of that 20-year period of principal guaranteed accounts, it's more than replaced the income that they've drawn during that first 20-year period. Both have that sustainable level of income and have that replaced later down the road so that they're able to take a sustainable level of income, have that peace of mind, really make sure that that income is there and provided.
Longevity is not a benefit for many retirees when you've got, all the other headwinds, a flat stock market, rising interest rates. If you're going to live longer, your money needs to last longer also. And that's not something that's really happening for people that are listening to the bankers and brokers putting their safe money in bond funds that just lost 20% and telling people to put 60 or 70% of their money at risk like they always have done. That's called an accumulation strategy that works in your 20s, 30s, 40s, and 50s. And when the markets go down hard, it doesn't affect you in your 20s, 30s, 40s, and 50s because every 2 weeks you put money into your 401k, your paychecks are coming from work. It doesn't affect you. In fact, you benefit from it when it recovers. The market recovers because you've ridden it out. However, when you're drawing income, this is when you're retired. When you draw income from a fluctuating account, we've talked about this already, you compromise gains when markets go up, you accentuate losses when markets go down, and it works until it doesn't. Millions of people showed up in 2009 because their portfolios were decimated with 2008, and they had to go back to work. They had to go to Plan B. So I'm glad that you talked about, Arrin, how the portfolio backfills itself with income coming from the laddered principal guaranteed accounts and the risk money providing that replacement. So if 65 years old, they retire, they're a couple, 1.2 million. 20 years later, that 20% or 25% of the money grows and replaces that 1.2 million for the second part of their retired life. Okay, let's talk about more of 2023. Corporate earnings are expected to go down. The Fed's supposed to continue to raise rates. Rising interest rates, a non-accommodative Fed, and lower corporate earnings means the expectation for 2023 is lower stock prices. History says that if you've got those three headwinds, you don't make money in the stock market. So that's the outlook. Now, geopolitically, what else do you see? There's some potential good news that Putin could throw in the towel and we get the end of that war over there with Ukraine. But looming is China. I don't know. What do you think? When do you think China hits Taiwan? What are your thoughts about that?
That is the $1 million question, isn't it? It's, obviously we've seen some of the damage that's happened from the Ukraine and Russia war, just from a shortage supplies, supply chain issues. And a lot of that has been around energy and food. But when you look at the China-Taiwan, it's a little more slated towards the technology side of things, where a lot of the semiconductors and highly advanced electronic components come from Taiwan. And so if there were to be some type of a conflict there, whether that was just them invading or there were actually manufacturing facilities that got put offline, the impact of that from a lot of the daily technology that we use. I mean, cell phones, computers, all the chips that go in the cars, anything like that, military equipment, a lot of the electronic equipment from, or the pieces that make up those things comes from Taiwan. So that could have a pretty dramatic effect. And then obviously every country that wants to control those things. So I feel like that could get pretty messy pretty quick, depending upon how that's approached.
This is a good contrast. So let's use this geopolitical uncertainty as a great contrast between how we do business and the bankers and brokers. So let's say that China, and it's true, it's very real. They could attack next week. They could attack 5 years from now. They could attack never. Any of those are on the table. But let's say you're in retirement, you have to deal with that uncertainty. Let's say that they attack tomorrow and markets are down a couple thousand points. How does our plan at Decker Retirement, how are our clients, talk us through, Arrin, how Decker Retirement Planning clients are protected?
That's a great point, Brian. And it's one of those things where nobody has a crystal ball. Nobody can tell you exactly what is going to happen in the next 1, 5, 10, 20 years. And so the best way to approach that is just being prepared for any type of market cycle that comes about. So where we don't know what the future holds, we can make predictions and best prepare to that. But really the way that we do it is by putting a foundational structure in place that prepares you for any type of market cycle. Where your example, Brian, if China invaded Taiwan tomorrow, markets tank for 75% of the portfolio for any given client, that has zero impact. They're not going to lose money on those specific investments. They're not going to have massive changes in their financial spending. And of the part that we do have invested in the market in those risk sections, we dramatically reduce the risk exposure that they have by using those two-sided models. So where a lot of people may be down 50, 60, 70%, depending upon the damage, our clients are okay. They're safe. They still have that same spending income. They still have that ability to make growth on the markets. And it provides a lot of peace of mind to everybody that we work with.
And the risk strategies, the 5 risk strategies, they react pretty quickly, don't they? When the markets change direction, they're not days, weeks later. They're very quick, aren't they?
They are.
Okay. So if I'm working with a banker or broker, Arrin, I was trained in this, and China invades Taiwan and markets are down 2,000 points, I'm going to be told to hang on and ride it out. So if that's the case and markets are down 30 or 40%, and I'm pulling money out of that portfolio, that is terminal. Do you agree?
I do. Yep. You make a big loss on an already down portfolio.
Okay. So now let's talk then about the current risks. So the job market is strong, and that means that the Fed's kind of frustrated, Arrin, because they want to slow the economy down. A strong job market means that the Fed is going to continue to raise rates longer. Do you agree?
Yeah, it's. I feel like it's been the headline for a number of months now, where they've continued to do these dramatic rate hikes, and I mean, some of the fastest pace we've had in decades, and it still hasn't given the desired outcome. I feel like that's the biggest thing they're focused on, and every time that jobs report or that unemployment report comes out, it's another disappointing thing to the Fed that it hasn't quite done, the rate hikes haven't quite done their job in their eyes yet.
Right. Okay. Well, we'll see on the Fed. Uncertainty is not a problem with the way we have our portfolios set up. So we'll see what happens. There is really a sad note that I wanted to bring up. I had a client, and Arrin, actually, you met with them first. $8 million. You met with him in August. He said, "Hey, my marriage, not sure what's going to happen. Let's meet again in January." Tell the sad story about how he was invested all $8 million of his money.
Yeah, so he had a pretty phenomenal rise to begin with. Had a really, really good return in his cryptocurrency investments. I think he made about $8 million in total from the crypto investments over the course of a couple of years. And things were looking pretty good. And we got the message, I think just this morning actually, that the place that he had all of his crypto held was hacked. Everything was taken. And now he's back below his original investment. He lost everything from that. So we've seen a lot of these in the last year, especially the last year. There's been a number of different crypto type hedge funds collapse, a number of different protocols get hacked, a lot of different, we saw the FTX collapse over the course of the last couple months. That is still going through bankruptcy proceedings, and it's not looking great for the depositors there. So unfortunately, the dramatic rise of crypto has also caused a dramatic fall. And it'll be interesting to see how all that plays out. But it's important to be really safe, careful with anything that you deal with in there, and make it a small percentage of your portfolio, because we would hate to have another story like the one we heard about this morning.
Right. And so how much crypto do you have with clients at Decker Retirement Planning?
Oh, very small. If anybody has that, most of my clients don't have any, and those that do have some, it's under 5% probably.
Yeah, and they're the ones that brought it in themselves and insisting on keeping it.
So if you have any questions, obviously at Decker Retirement, they're not putting all your money into crypto. If you've already got some in there, you want to make sure the rest of it's pretty safe. You can certainly come in and talk with the team. They're here to help if they can. They just don't know if they can until you reach out. It's 833-707-3030 again is the number. No cost for this chat. There's no pressure. There's no obligation. There's no judgment either. 833-707-3030. Come in and chat with the team. Have a phone call with the team, and find out where you are. It's a great opportunity. There's no cost for this. I don't know why you wouldn't take advantage, especially in these economic times that we're dealing with. 833-707-3030. Back with more Safer Retirement Radio. Our final segment ahead with Brian J. Decker and Arrin Wray. Back with more right after this.
We all want the freedom to do the things that make us happy, especially in retirement. To get help with laying the foundation for that freedom, call 833-707-2020 to have a chat with Brian. What if you ordered a pizza, but when you opened the box, a couple of pieces were missing? That would be upsetting, right? Now, think about how much you believe you've saved for retirement. Do you still owe taxes on that money? Brian Decker and his team at Decker Retirement Planning understand the importance of tax planning and can help you reduce the impact that Uncle Sam has on your retirement. Give them a call today to start working on your retirement tax plan at 833-707-3030. Now may be a great time to lower your future tax liability. Create a retirement plan today so that you can get as many slices of your retirement pie as possible. Give Brian Decker a call at 833-707-3030 and schedule a visit. That's 833-707-3030. Firm offers insurance services and may not give tax advice.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. You can always go to the website. A lot of information, a lot of offices Brian has as well. Offices in Washington, California, Utah, Salt Lake City, and Lehi. A lot of information on the website, DeckerRetirementPlanning.com. You can go to the heading right there on that website, Safer Retirement Education, where there's 12 different things you can download, including Brian's book on retirement, The Decker Approach. There's no cost for any of this. There's no obligation. It's there for your information. So again, that's DeckerRetirementPlanning.com under the heading of Safer Retirement Education. Take what you want. You have questions? Call the team then. Say, hey, I just read this. What do you think? I'm not sure how that affects me. 833-707-3030 again is the number, 833-707-3030. I'm Mark Elliott. Glad you're with us today. Arrin, in your debut on Decker Retirement's radio show, Safer Retirement Radio, great job. So I'm going to follow up because you were talking about you had a client that you'd met with in August, and he had a lot of money in cryptocurrency. Then you found out very recently that that account got hacked, and it was like he lost almost $8 million. I don't understand cryptocurrency. I'm 63, so I don't really deal with that. I would love to make $8 million somehow. That would be good, but I wouldn't want to have it all stolen from me by a hacker. How does that happen?
So one of the things that a lot of people don't quite understand is how the difference between normal banks, brokerage firms, that kind of stuff is compared to crypto firms, where if you put money into any bank, any brokerage firm, there's a lot of laws, regulations, governing bodies, all sorts of different rules, and people reviewing those things to make sure that they're following all the rules, that they have your deposits, that you can take your money out if you need to. There's a lot of different things that have to be put in place for one of those organizations to even exist in the first place. And on the crypto side of things, you can a little bit related to kind of the wild, wild west of the financial industry, where there are a lot of cool new things out, but there's also a lot of scary things and a lot of bad actors in that space where, I mean, even just over the course of the last year, there's been tens or hundreds of billions of dollars either stolen or misappropriated from different, sometimes mistaken, a lot of times fraud in that industry. And so, for example, this client had all of this money on this specific site, and because it's not governed or regulated by any of those normal entities that you would see with a bank or a brokerage firm, either somebody came and exploited that, meaning that some hacker broke into the site, stole all the money because the security wasn't good enough, or there are some times where the people running the site in and of itself just say, hey, there's nothing stopping us from running away with this money. It's all at our fingertips. We might as well just take this and disappear. And some of those things happen as well. So I would encourage anybody that if you even do have any interest in crypto, be very, very careful about where you invest your money, do your research, and again, make it a very small portion of your portfolio, because while all of the headlines typically tout, hey, you can make millions of dollars, or so-and-so went from working this McDonald's job to 10 million bucks or whatever, those are very much the unicorn once in a lifetime stories. And a lot of people have lost a lot of money, whether through their fault or no fault of their own, like this specific client. So scary things, exciting things, but please be careful if you're taking a look at that.
Hey, Arrin, let's warn people, perform our community service here on the radio and warn people of other things. So hopefully they're not in cryptos in retirement. That's an accumulation, high risk, high volatility investment. What are some of the other things? I've got one, and Arrin, you think of the others. I think one of the most, I don't have language strong enough, rip-off investments that are touted out there for our people in retirement is this one. It's a lifetime annuity or an income rider. And here's how it's trotted out. It's so deceptive, in my opinion. Arrin, how would you like to have, or Mark, how would you like to have 7% guaranteed up front and then 4% for life? It sounds really good, right?
Yeah, sounds all right.
Okay, so that's the catch. Here's how it works. Here's the math behind it. We're a math-based firm. We ran the numbers. 100,000 in 10 years, 7%. 100,000 grows to 200,000. It's a double. So now you're, instead of 65, now you're 75 years old. And at 75 years old, you get 4% for life. 4% of 200,000 is 8,000 a year. How long to get your money back? 8,000 into your original 100,000 is 12 and a half years. So now you're 75. That means at 87 and a half years old, if you live that long, you get your original investment back that you invested at age 65 with a zero return. We want to warn you against them. We hope you stay away from that. It sounds good. And I want to give the other investment professionals that they can't know how bad this is, but that means they don't know what they're selling. I just want to warn people to stay away from variable annuities, income annuities, life annuities, income riders. Categorically, we hope you stay away from those.
But there are annuities you like, right? I mean,
there's one class that we would have you look at, and it's called fixed indexed annuities or equity indexed accounts. Those accounts have third generation smart beta indexes and principal guaranteed growth rates that are averaging over 7 and 8%. That's the only ones that we would look at. So that's a good correction, Mark. Most all of them categorically, outside of that, we would just say stay away from. Arrin, what other things would you warn people away from?
Yeah, I'm going to tack on just one additional one from the income rider life annuity type discussion, is that one of the other things that most people don't realize is that you don't get your original investment back. If you do that deal you're talking about where you get 7% per year and then the 4% for life, as soon as you turn on that income stream after that 10th year and you start receiving that 4% per year, you no longer have access to that original investment, that $100,000. And so, for example, let's say you're 65, you have it grow for 10 years, you turn on the income stream and you died at 77, 2 years after you start that income stream. The insurance company takes the rest of that money. You don't get that original $100,000 back. So a lot of people don't realize that even though you do get that income stream, it's the trade-off of they get to keep that. And so it's kind of a bet on your longevity. That, I mean, yeah, if you could guarantee you're going to live to 110, 120, it might be worth it. But when most people are going to pass away long before then, it's not quite worth the trade-off you're going to take to do that, especially when you lose that original investment.
So why don't we like variable annuities? High fees, no downside protection. I just don't see any reason to put those in. This is just me. We've never put them into anyone's portfolio at Decker Retirement because on the risk side, they don't track with the S&P when markets go up because of the high fees, and they offer no downside protection. So they don't do anything that we want our risk funds to do. Anything you would add to the other things that you would warn people to stay away from in retirement?
Yeah, I would just say that in the world of annuities, there's a lot of different types. And like Brian mentioned, there are some that are very good, some that we use specifically here at Decker Retirement Planning, and they do fantastic for our clients. But there's also good annuities that are set up very poorly. There's a lot of different options and fees and different things that you can select that make a good product perform poorly. So when you're looking at any of those investments, it's very important to make sure that either you or the advisor you're working with knows what they're doing. Because not only can you select a good product or select a bad product, you can also select a good product and then set it up incorrectly. So that's why it's important for our team here to look at all of those things, make sure that we're doing our due diligence and really vet each of the things that we recommend to our clients to make sure that they are the best products possible for those given time ranges.
So give an example of how to set up an annuity and have it become poorly set up. So for example, you got a great annuity, clean, no fee, and its past performance is very good, high participation rate, everything looks great, and then you slap on an income rider. I mean, that's how I would think of ruining a good investment. But tell me your thoughts on that.
Yeah, you're right, Brian, that the income rider on there and almost any additional option you would select is going to cost you more. It's kind of like I would kind of equate it to a car in the sense that you can get a base model, but you can also add on the technology package and extra rims and tint and all sorts of stuff. And while you do get some good things out of that from a car perspective, on the annuity side, a lot of times you're paying for things that you may or might not even use. And at the end of the day, you're just handicapping that good product from the growth that you're shooting for, where originally, if you could have got, 6-7% from that specific investment, you tack on enough fees, tack on enough options that now you're getting 2% instead of 7, or sometimes even 0, depending upon how bad you set it up in the first place. So income riders and all sorts of different extras on top of that aren't really needed are things that people do that they think they're preparing themselves correctly, but really they're just using a good investment incorrectly.
So here's the bottom line. There are good annuities, there are bad annuities, and then there are good annuities that are set up poorly, right? So the idea is sit down with a team that actually works in the retirement world to find out, because annuities aren't typically used in your 30s, right? They're a retirement planning tool. The market, they've always got new tools in their option space. The insurance world, there's always new tools there. The banking world, there's always new tools. How do you know what's the right tool for you and your situation, or right tools, right? Probably need more than one. I mean, you got 3 worlds of money: the banking world, the insurance world, and the investment world. How do you make it all come together? Well, that's what Brian and Arrin, the team at Decker Retirement, are here to do. Help you put your plan together according to what you want out of retirement. And the picture on that puzzle box, right? Hard to put a puzzle together when you don't have the picture on the box. That's what Brian and Arrin want to know about your retirement. What's the picture of your retirement? How does it look? How can we help? And it all starts with a phone call, 833-707-3030. No cost again for this. The team's here to help if they can. 833-707-3030. It's a new year. Great time for you to start planning. Great time to sit down with the team, find out where you are, maybe make some adjustments if needed, or, hey, keep doing what you're doing because you're winning the game. 833-707-3030. Thanks for being with us again for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Have a great week. We're back again next week with more Safer Retirement Radio.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC.
Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.